Hi, this is Mr. Evans. This video is going to go over the threat of new entrant in Porter's Five Forces. We're going to look at this first bullet point here. So I did quite a long video on Porter's Five Forces. Yeah, I'm sorry about that. I don't like to I'll try and keep them a bit shorter than that generally, but this is a really important model that you can use to analyse the strategic direction that a business is going to go in, and it's a really important way of kind of analysing the characteristics of a market. So we need to go into a bit more depth on each of these different elements of the of Porter's Five Forces model. So the threat of new entrant refers to the ability of new businesses to begin competing in a market. In other words, the threat of new entrant is about how easy is it for a new business startup maybe, or a business that's in another industry to enter into a market. And the ability of new businesses to move into a market is determined by barriers to entry. Okay, so let's just go into a bit of detail about what I mean by that. Well, barriers to entry are things that would stop new businesses from coming into a market. Okay, there's things that would stop them. So what might examples of that be? Well, the first one might be high startup costs. So for example, if I wanted to open I would use the example of a barber shop previously. If I wanted to open up a barber shop, the startup costs would be the equipment that I'd need. I'd need probably a few months' rent. That's assuming I've already been trained as a barber, but relatively low startup costs there. Whereas for opening a car plant, an advanced car manufacturing factory, there would be quite high startup costs there. Economies of scale. Economies of scale are gained, of course, these are the cost advantages that you get by getting bigger. So economies of scale are, they're the ability of organisations to kind of employ specialist people, which cuts their average cost of production, to negotiate special deals with suppliers. And new entrants into a market find it very difficult to gain economies of scale. Legislation can be a barrier to entry. The need to comply with legislation. You can't just, for example, you can't just start up a transatlantic airline. There's lots of, obviously, health and safety legislation, regulations about the sort of personnel that you can use and the training they need to do. So legislation can be a huge barrier to entry, as to adhere to legislation, it takes time and it takes money. Existing brand loyalty within a market can be a barrier to entry. It's all very well me coming in and starting up my own business, but if all of the customers in the market are particularly loyal to one or more brands, then it's going to be difficult for me to take their customers away. And finally, specialist knowledge is a barrier to entry. If I want to enter into the pharmaceutical market and come up with a new drug to cure cancer or something like that, obviously fantastic aim, but I'm going to need some very specialist knowledge to do that, which companies like GlaxoSmithKline have built up and I don't have, and that forms a barrier to entry. So you need to be aware that the impact that each of these factors within Porter's Five Forces has on functional and strategic decisions. Well, in terms of barriers to entry, the strategy that we need to follow is we want to create high barriers to entry, don't we? We don't want people coming into our market and stealing our customers, stealing our market share. So our strategy should be helping to form higher barriers to entry to prevent that from happening. Well, how can we do that? Within marketing, we'd be looking to create some sort of USP, a strong brand image, so people don't want to go elsewhere, even if new competitors do enter the market. And we want to create some sort of price inelastic product, because that means we don't have to cut our prices, compete on price when new people enter the market. People are prepared to pay a higher price for our product. In terms of finance, if we're trying to create high barriers to entry, we're going to be allocating lots of budgets to marketing to improve our brand image, research and design, so that we're creating specialist knowledge for ourselves, we're learning about products, and we're making it more difficult for new entrants to compete against us. In operations, we might well look to automate production to cut our costs, gain economies of scale and specialist knowledge. Of course, there's an argument that we may want to position ourselves as a very handmade, very tailored product that's expensive. We could use that to create a barrier to entry, but you get the idea that what we're trying to do is invest to create barriers to entry. In terms of people, we're going to be wanting to do a lot of investment in training. Again, we're trying to build that specialist knowledge that becomes a barrier to entry, and these are the different impacts on functional and strategic decisions. You need to be aware of the impact on profit. So obviously, if there are low barrier to entry, lots of people can come into the market. You're constantly going to be having to cut your price to compete with new entrants. Always looking to invest to create those barriers to entry, so you're going to have lower profit. If you've got high barriers to entry, people can't enter the market, that's a sign that possibly you're going to be earning higher profit. Of course, this all depends on the unique circumstances of the business, but that would be the general rule. Okay, so that's the threat of new entrants.